Four key messages this week. Firstly, a review of markets, then an update from Fed Chairwoman Janet Yellen, a review of what's happened in bond markets over the past week, and then finally tie this into how our portfolios have been affected. In terms of global markets over the past week, equity markets relatively muted, small gains after the impact of the unexpected Donald Trump election victory. However, more interesting action is taking place in both the bond market and foreign exchange, where we've seen the dollar continue to appreciate and bond markets continue to sell off. Last week we heard from Fed Chairwoman Janet Yellen in her first public address since the unexpected election of Donald Trump as US President. Two key messages from Yellen. Firstly, no particular change to the path of interest rates, likely to raise rates again in the near future, but then future rates only at a gradual pace, effectively confirming the ongoing strength of the US economy. Secondly, for more seasoned central bank watchers, a key note from Yellen to say that she intends to see out the full term of her office, taking her through to January 28. This is significant as she had been perceived critic of Donald Trump's fiscal policy. Perhaps the biggest move in global markets last week came from the bond market, which experienced its biggest two-week drop in nearly a quarter of a century. Bond yields are important because they're a proxy for borrowing costs and they reflect the market's expectations for future interest rate moves, inflation and economic growth. A full employment picture as we see in the US, combined with incoming President Donald Trump's plans for fiscal expansion, have raised the market's concerns regarding future inflation. This is important as investors then require a higher yield to compensate them for these future inflationary pressures. As a consequence of the high yield, prices fall. Taking these bond market moves into account, how does this affect Coutts portfolios? For a long time now, we've been slightly cautious towards government bonds, preferring to invest in shorter dated maturities which are less impacted by inflation, and also to invest in corporate bonds where we can achieve a high yield. More recently, however, we've also invested in what we describe as alternative strategies, looking to invest in assets that have less traditional correlation with bonds and equities.